morning and welcome. Patriot Radio News Hour. Joe and Jason on this Monday. And, I'll say it again. Gold inching higher once again. We hit new all-time intraday highs on Friday, 2,203. Right now, we'll have a new closing high. Gold right now, 21.88. Silver is higher as well. And boy, are the markets going to let you in? That will be the question. We have a lot of data this week. The Fed's going to be quiet because we got a Fed meeting next week. CPI tomorrow. That's going to be a big one. What is that inflation number going to look like? PPI on Thursday. We also have retail sales on Thursday. And the consumer sentiment report, that will be on Friday. So a lot of news out there, a lot of news that are going to drive the market and what is going to play out, whether they raise rates, don't raise rates. Of course, they're not going to raise rates, right? But they're all wanting, here's what they're wanting to hear in the next week. Inflation isn't getting worse. I don't know that they're going to get that. We're going to want to hear that the Fed is still on track for rate cuts. That the dot plot, right? Yes, let's color in a little chart here. Are we going to get 3 rate hikes this year, or is that still the plan? Is that still the consensus? And then, of course, what about quantitative tightening? What is the drawdown going to look like as the reverse repo continues to empty out? And then, retail sales, that'll be an interesting one as well. But right now, people just pouring into the gold markets. The central bank buying continues at a breakneck pace. We had NVIDIA now showing a little signs of maybe fatigue. We'll see if it continues. They led the sell-off on Friday, a little bit of that today. Of course, Tesla, they've kind of fallen off. So, the Magnificent 7 down to the Magnificent 6. Maybe it's going to be down to the Magnificent 5. We'll have to keep waiting to see how it plays out. But never has the stock market been so isolated in such a few stocks as we have right now. But we'll see how this all plays out. But today, we're going to focus today. How much time before the debt eats us all up? We know, and I've been telling you, all these auctions are a sign of trouble. Right? We have to sell all this debt week after week, month after month, year after year. They keep right. Every quarter or two. Well, wait a minute. We gotta sell more debt, right? Because we keep spending it. The government just doing some continuing resolutions. Looks like they're reaching some consensus, and the consensus, just like we said, they're just going to spend more money. It really is becoming the big problem, and now people are starting to put dates on it. And here's the problem. These dates used to be, in 20 to 30 years, we're going to have a problem. Well, now it's 10 to 20 years, we're going to have a problem. 5 to 10 years, we're going to have a problem. Well, apparently, how about 0 to 5 years is kind of the new thought process and the bubble. All of this kind of goes hand in hand, right? We know we're in a bubble. All of you out there, you guys know. We all know. It's not a shock. I mean, that's just what they've done. We always knew. Hey, at some point, right, all the debt printing's gonna catch up to us, right? For a while there, we didn't want to do it to the children and the grandchildren. Of course, I told you guys 20 years ago, we are the children, right? If you're I'm 53, we're the children. That's gonna happen to us. My kids are those are the grandkids that they're doing it to. By the way, God, I wish we had Joey today. Joey's slammed with meetings, but Jason, I think this is the year of chaos as we've dubbed it. It is living up to its name, and now we have a lot more respected people saying, hey, guess what? The string of debt is getting ready to play out. The equity doom loop, the debt doom loop. It seems like it's right on our doorstep now.
Surprised that gold is at all-time highs again. This is 6 days in a row. I know it got on Friday. It really burst up there, didn't it, Joe? Right when we got off the Patriot show, it touched 2,200. So, but yeah, I think inflation is going to get worse. I think gold is usually a leading indicator, so it's going up and it's going up quite a bit. And hold on to the rest of this week, Joe. Who knows? It just sure seems like gold's going to keep on moving in a positive direction, and you should be buying if you have the ability to get into this right now, because when things start to crash, and they will at some point, the prices of these things will start to go in the wrong direction. Gold will either go down less or it'll go up. And better to be in it at, 2180, wherever it is today, Joe, than to have to try to get into it at 2380 or 2480, right?
Yeah, and this is something where not unexpected. Right, this is just the pattern that we've been seeing really since, I guess, the early 2000s. After Alan Greenspan said we could pay the debt off by 2010, and then we realized, oh wait, that was nowhere close to reality. When we get back, how much time? That's coming up. 800-951-0592. Joe and Jason here on this Monday, 2024, the year of chaos. It really is going to be just that. It's already shaped up to be exactly how we thought it would be. But the big part is what comes after the year of chaos. I hope you're diversified. I hope you're ready. I hope if you have old 401ks or you got IRAs and you're in these brokerage banks, I hope you're calling Joey and getting it out of there at 602-909-9048. Get it somewhere that isn't a bank. By the way, we lost 100 more actual banks in 2023. Real quietly. Some of them through failures. Some of them just got merged out of existence. Matter of fact, 2024 will be below 4,000, what I'll call actual banks, right? Below 4,000 actual banks. They still, like Charles Schwab, they say he's a bank, and Credit One's a bank, and right, all these, because they needed to be bailed out. Then you look at the markets today, right? The Dow's down 139, the S&P's down 18, the Nasdaq's down 52. Gold's up 4, 21.89. Silver's up 10 cents. The 10-year note at 4.1. Right? What is that going to look like when all of this data comes out? Can the Fed lower rates while inflation's still going? And the answer is yup. And I think they're gonna. Because there are no good choices now. Be diversified. What comes after chaos? Well, I think it's going to be a really, really hard next 5 years. Really hard. That's why I keep talking about why refi is another great alternative. If you still need to build wealth, right? You're not there yet. Because if you're there already, yeah, you better get into gold, right? And get into it hard. But if you still need to build some wealth, Hey, you get up to 10.25% return, not correlated to Wall Street. You don't have to ride it all the way down. Check them out. Now, you listen, as you know, you got to have at least $50,000. That's the bare minimum. You can use existing IRAs. InvestYRefy.com. That's the word invest, the letter Y, REFY.com. And for me, just call them. 888-YREFI24. Let them know, hey, Joe and Jason told me I got to get this done. It's really just that simple. They don't play games. They don't have fees. They don't attack your principal if you need your money back. They're just really, really great people to work with. And you better get ready because we're on the clock. And the clock is ticking. Right? We're getting all of the warning signs. The longest yield curve inversion in history right now. Well, what does that mean? Well, how is that a clue? Well, real simple. Every long stretch of yield curve inversion leads to a bust. Right? What was the longest yield curve inversion before this? Well, let's see. The second longest before this one was the financial crisis. You remember that one? Right? Everyone lost their homes, right? Stock market crashed. All these banks that weren't banks had to become banks because, that they were going to go under, right? All that nonsense. You remember. What was the longest one before this one? Oh, yeah, that little thing. What was it called again? Oh, yeah, the Great Depression. I don't know. I don't remember that one. I wasn't around. Not too many people still around from that one. But you get the idea. You understand it. Right? We have, what other signs do we have? Well, let's see. We've got sky-high deficits. We have central bank gold buying at all-time record highs. And now everybody and their mother, it takes them a little while, coming out saying, man, this ain't stopping. You have people openly questioning what's going on in the bond markets and the fact that people are now saying, you know what? Yeah, this isn't working for us. Right? We keep losing money. We lose purchasing power. We keep it in treasuries, and we're ending up with less and less and less. And now they want the Fed to what? Cut rates again. Eric Peters, One River Asset Management. He had an article out talking about, hey, this is what we're talking about. This is what we're looking at. Hedge funds. What are these hedge funds looking at? What are they thinking? The last time we had debt to GDP like this, by the way, that was the end of World War II. Kind of, think about that. By the way, the deficit at the end of World War II was about $400 billion, a little under that, most of which, over $220 billion of it was from World War II itself. And then we went, people don't remember, Jason, we went almost 30 years, 20-some odd years after World War II. We ran just as many budget surpluses as we did budget deficits. We didn't start going into the continuous debt cycle until after Nixon and then the government closed the gold window in 1971. And guess what? We've never run a budget surplus since. The last trade surplus we ran, I want to say it was either 1972 or 1973. Now we go almost $1 trillion in debt of wealth, leaving this country in trade, never to be seen again. And now, all of a sudden, we're going to have the worst debt to GDP problem that the world has ever seen. And it's not World War II, right? This is just, hey, you know what? We wanted to make the good times roll. We didn't want to be fiscally responsible. And now, Jason, the taxpayer is going to be the one that pays the price.
By 1980, we started a 40-year rate decline cycle that ended this last bunch of years at zero for so many years as they're pushing and pushing this as far as they can. So most likely we are in an inflative cycle with a rate hiking cycle, which could last 40 years. But it looks like the higher rates are here to stay, and we'll see it go up and up and up slowly over time. Everyone's going to get used to 5%. Then everyone's going to get used to 6%. And then there'll be some problem and some emergency, and then it'll be at 8%. Then it'll come down a little bit, and then it'll go back up above 8%. I don't know, maybe it's only 20 years this time, but it doesn't matter. It ended with massive inflation and rates. I mean, people had 20% mortgages, right, Joe? I mean, it ended really badly until the big spending in the 80s and Reagan and now we just spend because the rates are going to come down. The difference is the debt. They're going to have to reset this thing, and the last time they reset this thing was World War II. That's kind of the only thing that matches where we're at now is World War II in the Depression, and that's where we're at. And you got so many guys calling for depression now, right, Joe? I mean, it's not that hard to call. Nobody knows the severity or exactly when it's really going to get worse.
How did we do it? And the answer was Bretton Woods. That's how we did it. That was the win, and the bankers stole it from us. What a great win it was. For those of you that don't know, Bretton Woods was an agreement that we essentially forced the whole world to sign it. Right? Okay, here's the deal, right? We saved the day. Everybody signed this that says you got to buy everything in dollars. Everything. Which meant we could, to Jason's point, we went on a 40-year, really 50-year debt blow-up. Well, at the same time, this huge 40-year stair-step down on interest rates. Think about, interest rates were like 16% when Paul Volcker came around. And it ended at zero for 15 years. But one of the other things that now is different and why so many people are saying, hey, it's coming to an end. Bretton Woods no longer exists. Doesn't exist. You don't have to buy everything in dollars. And guess what? That's exactly what's happening. Now, people can pretend, oh, no, it's okay. The dollar's the best. I still hear some guys on the idiot box trying to convince people it's not happening. See, because here's the problem. With our debt as big as it is, we need everybody to buy everything in dollars. Listen, the dollar going down to 50%, that math doesn't work now. And that's exactly what's happening, right? Remember, India, the latest now, right? Hey, all you Arab nations, all you BRICS, friends of BRICS, let's start this path going. Eric Peters says now there's a growing conviction that in the next 2 to 5 years, 2 years from now is 2026. By the way, Medicare, Medicaid comes due in 2026. These guys, they pass so many dumb laws. They revamped Medicare, Medicaid, added some stuff. Somehow they added things and said, oh, no, it's going to pay for itself. You know how many hospitals are closing right now? It's not working. It's not working. The U.S. is going to face a debt sustainability crisis, sparking a major global market event. Remember what Jason and I have been talking about. 2024 is the year of chaos. We're more worried about what comes after the year of chaos. This is exactly what Peters is talking about. And this is just math, guys. And not even hard math. Right? This isn't hard math like the Fed and their hard math. We don't even know how they calculate it. We actually got to be dumber to understand how these morons try to explain why inflation is only, 4%, when we all know that's a bunch of crap. People from within our institutions are raising the alarm. Well, you don't see it, though. Right? I mean, I know the Dow's down a little bit today, but it's still 38,000. A 30-year decline with a projected 30-year increase in debt to GDP. Kind of Jason was saying 40. This guy says 30. Hey, close enough. Patriot Radio News Hour, Joe and Jason on this Monday. And we were quoting Eric Peters, a major hedge fund industry CIO, and talking about where the United States is heading, and it's heading for a major debt crisis. This matches up, right? Because we're seeing, why is it that these countries are really buying all this gold, right? Is it just to hedge the dollar? Probably not, right? Is it to get ready for what they already know is coming? And, of course, our bankers know it. You hear Jamie Dimon, he'll talk about it, right? He'll tell you a little bit. But more and more, we're hearing about this. And here's the big thing. Because he's talking about projections from the Congressional Budget Office. And, of course, they only can do, here's what people don't know. The Congressional Budget Office is absolutely worthless. Because they only can use the numbers given to them by Congress. So right now they're saying, hey, we're going to have GDP growth over the next 30 years of 1.8%. And, oh, by the way, they're only anticipating long-term real interest rates of 2%, right? And they're still come up with these horrible debt numbers. But Peter says that's not going to happen. And then he started talking about the main source of long-run upward pressure on primary debt. Spending on mandatory programs, Social Security and Medicare. They're not mandatory, by the way. And you know what? I hate to say this, because I run commercials on 1360 about this. The Supreme Court already ruled. Medicare, Medicaid, Social Security, that's just a tax. The government doesn't have to pay you a cent. That ruling was done in the 60s, by the way, just so you know. Because I'm worried now if Peters is right, and I think he is. If we have debt problems, well, what are the biggest parts of the debt? Well, there's only 4 parts that really matter. Social Security, Medicare, Medicaid, interest on the debt, defense. Well, you can't change one of the 4, which is the interest. Can't change that. You can lower it all you want, but as soon as nobody wants it, it doesn't matter. The other three, well, what can you do? All you can do is cut them. That's all you can do. Raise taxes and cut them. Current legislative formulas. Spending on Social Security and government health care programs, especially Medicaid, combined with the projected aging of the population, will point to the largest increase in spending in these programs as a share of GDP. And he really notes something interesting. We didn't have the ability for people to buy things without dollars, right? We had Bretton Woods after World War II. Medicare, Medicaid, that didn't even exist. Right? That was a program that didn't even exist in the United States after World War II, and with no political party willing to adjust these programs. Jason, this is an easy call. You've got 2 to 5 years. And I'm thinking 5 years is going to be very, very generous because as I've educated all of you, Medicare, Medicaid come due in 2026. Jason, the math doesn't work. It's just that simple.
And starting this year, I think going for the next 4 years, about $8 trillion or more is being rolled over, and which means the interest rates on all of it is higher for the next 4 years. So the amount that's leverage that's pushing that those interest payments is going to go higher. I mean, there is solutions to this. It will require a lot of pain and suffering, and our government going back to being constitutional. You know, we could have the Treasury, when that debt rolls over, print up fiat currency with no interest, and just replace the $8 trillion with $8 trillion in fiat currency, which I know what happened. It would be a lot. I mean, inflation would blow up, and all this debt fiat would go out of existence very quickly, and the world would go berserk. I mean, they can't do it now. The Fed's got everyone right where they want them in some respect, but that's how you do it. The Treasury can do this. Emit bills of credit. Pay off the bills that are causing us to have $1 trillion every 100 days in debt payments. You know, interest on the debt. But, Joe, I don't think we'll ever see that, you know. What kind of explosion, how bad is it going to get? What's it going to look like for the average person? The lower standard of living just grindingly, slowly just taking away, and people just accepting it. It's hard. You know, they sure got a lot of distractions to keep, you know, how poor are you? Well, as long as you got a little device in your hand and you're worried about celebrities and what video games you got on there, you know, I guess they can keep you tied up. You know, you spend all your time in a fake world. I guess they could pull one over on you, but for the average person that has to work and actually pay the bills, so the other person can sit there and do nothing, it's getting harder and harder, Joe. The worker that actually pays for the rest of the household, it's a crushing weight to have to keep up. And nobody's wanting to fix it, Joe. No one wants to do the hard work and actually fix it.
Yeah, and again, I think that's something where, unfortunately, because it could have been done. But unfortunately, they wanted to have the easy button, right? They wanted the easy button. Well, what was the easy button? More debt. That was easy. Let's bring rates down to zero for 15 years and take the debt from $10 trillion to $30 trillion and pretend like it didn't matter. Right? Well, now guess what? It matters. It matters a lot. And you just have no idea. Look at China already announced, hey, we bought another 12 tons of gold in February, right? We're just going to be just socking it away. Right now, gold's up 21.92, and no end in sight here for what is coming. I hope you're getting prepared. I hope you take what these people say seriously. But unfortunately for most people, they're not even aware it's happening. Patriot Radio News Hour will be. 800-951-0592. Joe and Jason, Patriot Radio News Hour on this Monday. Today's gold special. And, get it while you can. We've got all kinds of data out. I think the bigger data points will be CPI, PPI, and then retail sales. I think that's going to be another one of those that fits. I think on the inflation side, here's the problem. I don't think it's going to matter. Inflation, as long as it's not outrageously worse, they're going to live with it. They're going to live with it and try to convince us that somehow it's still going to get better and that this is, the anomaly, the bump in the road. And then a soft retail sales number will kind of be enough to really drive things here as we get ready for the central bank the following week. Right now, gold's up 6, 21.92. It'll be a new record high close for gold. Today, once again, I mean, I don't know, what would that be, the 5th or 6th in a row?
6 days.
Today's,
yep.
Right? Today's special. Well, we have quantities. $10 liberties. 1 through 9, 11.80. 10 through 19, 11.75. 20 to 49, 11.70. And while you still can buy in these types of quantities, 50 or more, $1,165 at 800-951-0592. And right now, $10 pieces at any one of these levels is cheaper than 20s. I don't think it's going to last much longer. We've had a nice run here. But Jason, this is just what the markets are saying right now, that, hey, you know what? You guys said that you were done raising rates. You've killed inflation. But guess what? All of that money, all that excess liquidity that you created has evaporated out of the system. And now, with the hard part coming, because they knew this was coming. But inflation was supposed to be beaten by the time it got here. That hasn't happened. They're gonna lower rates with inflation well above 2%, and guess what? Create an even worse storm in 2025.
Yeah, they had their super core number wasn't good either. That was their number. So what's tomorrow's CPI going to be? I'm sure it's going to be 3 something. If it's in the 2s, I'd be kind of shocked. But I mean.
Well, listen, if it's in the 2s, I'll say this. If it's in the 2s, yeah, gold's going to be well above $2,200 if it's in the 2s. And it may, you got to remember, they don't actually track inflation. I mean, that's not even what that number is about. But nonetheless, Jason, I don't know that the number can be high enough because they know that rates have to come down. Otherwise, guess what? The banking industry isn't going to survive. It's just that simple, Jason. There's no easy way out here, and gold knows it. Silver knows it, right? The markets know it. The hedge funds know it. The Federal Reserve knows it. The other countries of the world know it. Why would they use the Chinese renminbi when they could use the dollar? Why? I'll tell you why. Right? Because you know what? I'm getting my you-know-what handed to me. Every time I turn my treasuries in, it ends up being a bad deal. That's why.
A little over a year ago, I told you we very likely could end up in a situation where we're printing money and inflation's going up. And you're like, this just seems like that's, it's just ridiculous. It's just a ridiculous situation. But what you're just saying is interest or inflation could be going up and money printing is coming because, dropping the rates means they want to hurry up and start printing. So we very likely, Joe, could end up in that situation, which it is counter to economics, where you have inflation going up and you have printing of money happening at the same time. And this is really the best way for the Fed to kick the can down the road, maybe even another year, I don't know, which is to print money and kind of inflate their way out of this situation that's happened. But, I mean, the numbers are so ungodly big, Joe. I don't know how long that could last, but it sure looks like that's what they're looking for. I mean, look at all the spending that's going into these markets, which are in everything, the price of everything going up. I'm seeing housing in my area going up again. I just didn't think I'd see housing going up again, but housing in my area is going up again. It's just doesn't make sense, does it, Joe? And it sure has the inflation of the Depression, or even like the inflation that's happening in Germany. The inflation that happens anywhere. It sure has the markings of hyperinflation coming. And man, that hot potato, who's going to point the finger at who in that situation? I mean, did you hear Joe Biden the other night saying that he was talking soft landing? He mentioned soft landing the other night. They're still using that.
There is no soft landing. I've said it from day one. That is nothing more than wishful thinking, and it's not going to happen. And again, we'll use New York Community Bank. I guess let's all thank Steve Mnuchin for saying that. Of course, I'm sure he got a ton of assurances. Oh, don't worry, we won't let it happen to that bank. And I'm going to tell you right now, those assurances mean absolutely nothing. America's on the clock, and the clock is running out of time. You know what I'm saying? Yeah, we're probably already in double overtime. Patriot Radio News Hour. Get your gold put away. We'll be back after the break. 800-951-0592. Once again, today's special $10 Liberty half ounce. These are the old coins, 1866 to 1907. Jason, I had some people coming in, and they're like, hey, what's the difference? Because, the beauty of the internet, right, you can always find something that will support an argument one way or another. Oh, it's not that important, or it really doesn't matter. Let me tell you right now, privacy always matters. It's the only gold that you can buy, sell, trade in any quantity. And you don't have to be 1099, period. Can't put them in an IRA. Why do you think that is? It's the only gold the government says are now considered collectibles. By the way, go back to the Confiscation Act, the Gold Confiscation Act of 1933. There's only one type of gold people could own, only one. Had to be a collectible gold coin, or you couldn't have it. You just turn it in otherwise. Are they going to confiscate gold again? See, a lot of people tell you, well, they won't, because gold's not the money anymore. Well, what did Mr. Peters just tell you about? Hey, all of us, we all see it. We're going to have a debt crisis. That means a massive loss of confidence. Will you restore confidence? Because let's face it, whenever the debt crisis comes, right, the $40, $50 trillion that we owe, we still owe. All those unfunded liabilities, we still owe. So yeah, could our government confiscate gold again? I think they could. Now, does that mean pre-33 won't be in there? I don't know. It wasn't the last time. You know what? And you know what? Hey, here's the other. It doesn't cost you anymore. They cost the same, and in some cases less. Right today, $10 Liberty half-ounce gold coins, 1 through 9, $11.80. 10 through 19, 1175. 20 to 49, 1170. 50 or more at $1,165 at 800-951-0592. And Jason, like I said, I think this is going to be another wild week. Tomorrow is going to be the CPI number. How hot is it? I don't think it's going to matter. It won't be hot enough that they say that the Fed will somehow not be able to start cutting rates. And then, of course, we've got retail sales. I'm expecting that number to be significantly lower than it's been. And then, did you see the Wall Street Journal today? The rating of the 401ks continues, Jason. I mean, this is another thing. We saw this during the financial crisis as well, didn't we? People that just couldn't afford to pay the bills emptying out their 401ks, and it's happening again.
Yep, I've mentioned it before. It's this is the cycle, and this is how they get the people at the bottom to just give up everything they got. It's the haves and the have-nots, Joe. It's being on a massive scale. It's happening right now.
800-951-0592. Joe and Jason coming right back with the half-empty cup.